let's proceed to our fourth session, focusing on the key topic of this budget, capital gains. So the capital gain topic is divided into two parts. First, we'll explore changes in financial securities, followed by the next session, which will be exploring the changes on non-financial assets. So to begin with changes proposed for capital gains on financial securities, we're excited to welcome Brenden Saldanha, partner at EY LLP Financial Service Tax Practice in Mumbai. With over 20 years in financial services and banking industry, Brenden specializes in tax and regulatory advisory, fund structuring, and compliance. He has worked with global investment banks, asset managers, and Indian private banks, and has an experience at the India Tax Desk in New York. He holds a bachelor degree in commerce from the University of Mumbai and is a chartered accountant. The stage is all yours, Brenden, and I'm so sorry for the running delay.
Not a problem, Ridhima. Can you hear me?
Yeah, definitely.
Right. Thanks, Ridhima. And not only I have the misfortune of following such a great session by Mr. Bhutani, but I also have the post-lunch session or during lunch session. So I hope that people will be enthused to listen to me on these changes that have come in the budget. But good afternoon to everyone. And thank you, Taxmann, for this opportunity to present on this budget, especially on some of these great changes that have come by the finance minister, trying to simplify matters and in some manners complicating them, if one may look at. So I'll quickly, and I know we are running short of time, so I'll quickly go through some of these changes in the context of capital gains on financial assets. This is the first time that the finance minister has introduced this concept of deeming some assets to be financial and non-financial. And what I'll be covering is financial, which covers shares, stocks, bonds, NCDs, all those types of investments, wherein the intention of the government is to streamline the taxation and the period of holding across all of these assets. And I'll first start with really because there's a lot of cross linkages between different types of assets. And last year, if you recall, for the first time, the finance minister had introduced the concept of a specified mutual fund by which any specified transfer of any asset of a specified mutual fund, the gains would be deemed to be arising from a short-term capital asset. And the manner in which this was done, which was effective April 1, 2023, was to state that a SMF would be a mutual fund where not more than 35% of its total investments were invested in the equity shares of domestic companies. Now, this gave rise to a lot of confusion, as one can imagine, over the last couple of years, wherein even assets like gold bonds, ETFs, some of these which were not intentionally debt assets were falling within the purview of this specified mutual fund because it's said by whatever name called. And so there was a lot of confusion on whether this would apply to even investments in international funds, for that matter. Under the LRS, you can invest in international funds because those were not 35% in domestic companies, whether those also were subject to a short-term capital gains tax. Obviously, a lot of feedback has gone to the government, including the fact of fund of funds investments. And so this time they have sought to clarify that and amended that budget, that provision, wherein now it's pretty clear to state that any mutual fund, by whatever name called, investing more than 65% of its investments in debt securities or money market instruments. And these will be as defined by SEBI, or a fund of fund which is investing in such mutual fund schemes or such securities. Now, let's look at why these provisions were introduced. Obviously, you had interest income, which is taxed at the slab rates or the highest rate, whereas investments in mutual funds, which were investing in these very securities, you got the benefit of indexation or a lower or long-term capital gains tax rate, which effectively reduced your outgoings on tax, which was essentially interest, but obviously coming to you by virtue of growth schemes that were issued by mutual fund schemes. So the intention is very clear that if there is investments in equity or equity-like instruments, then those will be taxed in one manner. But if there's intention is to invest in debt securities, then even going through the mutual fund route is not going to allow you to get that benefit. So to that extent, now you've got a very clear message which says that any investments more than 65% in debt instruments or money market instruments, these will be taxed at as a short-term capital gain. The only interesting thing, and I know whether interesting or more cute thing that has been done by the finance minister this time, is that this is effective 1 April 2025. Therefore, the ambiguity that has risen by virtue of this provision last year continues from last year into this year and will continue up till March 31 of this year. So that's something that one will have to see, and what's the impact of that one will have to look at in terms of how they are being treated for these current years in terms of the investments made. Along with this, the other asset that has been deemed for the first time, this time as a short-term capital asset, is unlisted debentures and bonds. But this has been made effective from 23rd July 2024. So any redemption, maturity, transfer of any security after 23rd July 2024 in unlisted debentures and bonds, these as well would be now be regarded as short-term capital assets. So now once we've seen those definitions, I thought it may be simpler then to look at where we stand today in terms of the rates of tax, the period of holding for the various securities that we have right now. So listed securities, equity-oriented mutual funds, zero coupon bonds, nothing changes. 12 months remains 12 months. That is not sought to be tampered with. The intention of removing the 36 months period comes to light with the listed units of business trust, which are the biggest beneficiary really of this, wherein now listed units of a business trust, the period of holding more than 12 months will be regarded as long-term capital gains. The unique one now, this hybrid mutual funds, which are more than 35% equity, but less than 65%. Obviously, if it's more than 65%, then it becomes an equity-oriented mutual fund. But these ones which straddle in between, they will now enjoy a 24-month period of holding if it is to qualify as a long-term capital gain. Unlisted market-linked debentures, debt mutual funds, money market mutual funds, all were deemed to be short-term capital assets last year, and they continue to be deemed to be short-term capital assets now. The unlisted bond that I spoke of just now, those are now deemed to be short-term capital assets, whereas unlisted shares now continue to be 24-month as a period of holding. By virtue of this, what you see is that you only now the 36-month period of holding is completely done away with, and you only have a 24-month period as a long-term capital asset if that were to be entitled to be treatment to a long-term capital asset. Now, the one thing that we thought was a little bit unique is what happens to assets like gold ETFs, international funds, because it's very clear that these are effectively long-term capital assets post 1 April 2025. So now you've got this unique situation where for gains up to or investments up to April 1, 2023, these will be long-term if they are held for more than 36 months. For the period April 1, 2023 up till 31st March 2025, effectively by virtue of this anomaly in the provision, these are likely to be regarded as short-term capital assets if they were transferred in these 2 years. But with effect from 1 April 2025, these now become long-term capital assets if they are held for more than 24 months. So again, this becomes a little bit of an anomaly in terms of how these are to be treated. In obviously the intention by the finance minister to make these simplified. Obviously, there are some loopholes that are let out, but that's something that will need to be seen. Moving on here, I mean, I've been a practicing chartered accountant for over 20 years, but if someone has to ask me what is the capital gains tax rate, it sometimes leaves me dumbfounded, because obviously the tax rates are varied, and for different periods of holding of time, it's very difficult to explain that. And obviously that's coming out in this slide, and obviously you can see this at a later point of time if this is too small, and I apologize for that. But I thought it would be necessary to see what are the real changes and if anything is left out. The first part, if you look at it, and this is bifurcated into 3 parts, really broad aspects of investors that we see. One is the FPIs, which are investing under the foreign portfolio investment route. You have foreign investors investing under the foreign direct investment route. and obviously you've got the resident individuals at the end. What is clearly changed is obviously an increase in the tax rate for both long-term and short-term capital assets on the equities and equity-oriented mutual funds. Long-term capital gains have increased from 10 to 12.5%, and short-term from 15 to 20%. The indexation benefit obviously wasn't applicable to this for most of these investors. So that's a big impact for those investing in these kind of securities. If you recall, the STT was introduced way back in 2004 under the guise that on the basis of payment of securities transaction tax, long-term capital gains was deemed to be exempt. That obviously changed back in 2018. And now where that rate was 10%, this increase to 12.5% will impact investors further. Again, equity capital gains on equities used to be 30% or slab rates. That would come down to 10%, 15%, and now it's increased to 20%. So that's a big change for those investing in capital markets, but that's something that the government believes that they've taken in their stride. What has also changed is the exemption for long-term capital gains on these investments on equities. Earlier, there was a deduction or an exemption for 100,000. That's been increased to 125,000. That's a marginal relief that's been given to small investors. Moving on, if you look at unlisted equity shares, there's no change. Obviously, from an FPI perspective, it's still 10 and 30. What has changed is from an FDI perspective. Earlier, there was 112C3, which taxed rather capital gains earned by a foreign investor in unlisted securities to be taxed at 10% without giving FX benefit. There was always a confusion in terms of how this would be computed, because one would normally, before reaching 112, you do a computation with regard to the FX benefit under the indexation benefit really under 48. And then if that gave you a gain or a loss, if it gave you a loss, you would take that loss. But if it gave you a gain, once you come to 112C3, you need to take out that benefit and really tax it at 10% without an FX benefit. But now this is very clear now that indexation has been taken away. The FX benefit will be available to investments in unlisted securities. So that's one thing that's very clear in this budget, that increased rate of 12.5% will apply, but the FX benefit that will be available to foreign investors that comes in. So that's brought about some cheer. I mean, depending on how you look at it in terms of how the FX moves. But given how FX has moved in the past, this should bring about a significant cheer to foreign investors in unlisted securities. The benefit is really in terms on the resident side, where that rate has gone down from 20% to 12.5%. Obviously, many people took the benefit of indexation and applied a 10% rate earlier, but now with that gone away, all capital gains taxed at a nominal at the straight rate of 12.5%. Again, on business trusts, those rates increase from 10 to 12.5% to all for long-term capital gains, and from 15 to 20% for short-term capital gains. The benefit here, as I pointed out earlier, is that now the period of holding is only 12 months. Unlisted business trusts, these now enjoy a lower threshold period of 24 months for qualifying as long-term capital gains. I'll come to the FPI part later on, but on FDI, these rates have increased to 12.5% for long-term and 30 to 35%. The 35% being the reduction in the foreign tax rate for foreign companies. Again, moving on to NCDs, again, these increase from 10 to 12.5%, 12.5% for residents without indexation. NCDs, again, now these are deemed to be short-term capital assets. So these will apply at the prevailing rates, at the slab rates, and that will be applicable from 23rd July. Transactions on listed derivatives, no change. These continue to be applicable at the slab rates. As I pointed out earlier, indexation has gone away. So that was a little impact to foreign investors other than really in terms of long-term investors in private equity. But that's gone away from 23rd July 2024. And so that's going to have a significant impact. But obviously, the government believes that the simplified computation of this capital gains will provide some relief to investors. The point that I wanted to bring about in terms of one anomaly was that if the intention of the government was to have simplified rates of 12.5% for long-term capital gains for everyone, there seems to be an oversight in terms of FPIs because 115 AD, I beg your pardon, 2C, which talks about the capital gains taxation for on long-term capital gains for FPIs, taxes is at 10%, and it is only the proviso which takes you to 112A that the rate has been changed from 10% to 12.5% with effect from 23rd July. So to that extent, what it applies to is only to equity shares. That's the interpretation that you would get from reading the Bear Act. But I'm sure that this probably is an oversight, because if the intention is to have the rate of 12.5% applicable to all investors, then affording that only to FPIs under 115 AD clearly may not seem to be the intention. And probably as the bill is tabled and it finds its way through Parliament, you would find that rate changing to 12.5%. Another question that comes about is with regard to the offset of losses, because you have capital gains which will be taxed at different rates within the year. This isn't the first time, or it's not the first time that this is a case. This has been debated in the courts as well, with first investors and various other judicial precedents, wherein the courts have held that if you have gains taxable at different rates, you've got currently as well gains which are subject to STT taxable at a lower rate as compared to short-term capital gains taxable at a higher rate. The courts are very clear on this provision, which state that all the gains taken together can be offset against gains taxable at different rates, because there is no bifurcation in the provisions of Section 70. And therefore, to that extent, in this case, where there are different tax rates that are applicable to gains that are earned from 1 April to 23rd July, and a different rate from 23rd July to 31st March, you obviously have the ability to claim the offset. So obviously one would then take the position that you would aggregate all your losses within the year, irrespective of what rate they are taxed at, and then offset that against the gains arising post 23rd July first, because that's taxable at the higher rate, and then moving on to the gains that are taxable from April 1 to July 23rd. So that's pretty much how you would treat those losses. Moving on, there is an increase in the STT rate for securities in options and in futures. This is hardly a surprise. The surprise being, well, if one has to look at a surprise, it's that the rate has increased by marginal amounts. Given what the SEBI and the government have been proclaiming over the last several months in terms of the froth in the market, the volumes that have been traded on futures and options, India seems to have one of the highest ratios. From what I've heard, more than 50 to 60% of the volumes of F&O traded in the world in the retail market are traded in India. So it's kind of become like more of a gambling addiction that at least the SEBI has pointed out. And therefore, while there was an expectation that derivatives and trading in futures and options would be taxed at a much higher rate, akin to what was seen last year in the context of VDAs or crypto, that doesn't seem to have come through. Instead, what we have is a nominal increase in the taxation on STT. I would think that this is hardly going to deter anyone from trading in F&O if they were doing before. Anyhow, they don't see these numbers coming through in the actual trade books, so unlikely that this is going to change. But anyhow, it's something that the government has taken a step for. The last thing that I wanted to cover is in terms of the shares offered in IPO. There was, obviously, as I mentioned earlier, there was the change in the taxation of long-term capital gains back in 2018, when capital gains, the long-term capital exemption was removed with effect from and grandfathered for gains that were made up to 31st Jan 2018. What was unclear at that point in terms of if shares that were tendered in an IPO, how would one value the gains that were to be grandfathered up to 31st January 2018? And in many cases, the position was taken that the fair market value as on 31st January 2018 was to be considered as the basis. But this budget has amended that to say that what will be allowed is only the cost inflation index up to 1718. And that's a big hit to many people who would have taken a position, or any persons offering the shares in the last 4-5 years, because this is a retrospective effect from 1819. And therefore now you would not get that that step up in terms of the fair market value. This is going to result in significant reassessment proceedings, provided those limits with the reduced limit in reassessment proceedings that are available. Then this would definitely become one topic. Revision proceedings also are possible, and therefore this is something that needs to be looked upon by anyone who's taken that aggressive position in the last couple of years. The other thing is that this amendment is only with respect to equity shares, and it doesn't apply to business trusts. So any REIT offerings that have been taken place in the last couple of years, whether this will have a ripple effect in terms of making the intention of the government clear, and therefore forcing people to probably take this view, that's something that remains to be seen. But by and large, I would think that if this is the intention of the government, that's something that the tax authorities would also look to address. So that was really in terms of financial assets. I know it's not much in terms of what is there, and I hope I've covered most of the topics, but Ridhima, if there are any questions, then I'm happy to take them.
Yeah. Thank you so much, Raghav. I think this is actually a topic which requires a lot of in-depth analysis, and thank you for your analysis on this. We have few questions coming in just a moment.
Sure.
So, one is actually my personal question, which we have seen a lot of debatable topic in the news also. Do you think I saw RBI governor's interview, I saw the economic survey, and there was a clear intent that government is sort of in a state of shock or surprise that people are investing a lot in FNOs, in capital markets, and the traditional saving has totally shed its way out. So, do you think this kind of move will discourage retail investments in the market?
No, I don't. Frankly, I don't see that coming through. And essentially, if you look at it, the addiction, if I may call it, to invest, it will very rarely take place. It will be deterred by small changes in STT. I think there have to be larger macroeconomic changes done to really deter retail investors. See, at the end of the day, one should understand that tax is a function of gain. So people who are earning gain significantly won't mind sharing tax, whatever it is. I think what is necessary to be changed is more from a regulatory perspective. If you have, lot sizes, the amount of money that you have to put to trade in FNO right now is very limited. You've got mini lots, you've got, expiries happening on a daily basis. That is something that will, if that is changed and, you have larger lots and the money at risk is larger, that's when you'll probably find people, being a little bit deterred from investing. But changing of STT rate by 0.0035% or 0.065%, people are not going to be bothered by that. Yes, if you have, a significant tax rate of, 40% or 50%, that may deter people, but, it is not going to be conducive to have different rates. You'll not have, it's necessary to have derivative investments in the industry, but you can't deter it to a great extent from a taxation perspective. So I think regulatory changes are more warranted rather than tax changes.
Noted. And we see, so this is something which is another query coming in, was about this 1,25,000 exemption limit, which has now been increased under Section 112A. People are wondering how this would be adjusted. Will it be on FIFO method, or the way it beneficials to the SSC the most?
It will be on the benefit. Basically, at the end of the day, it's 125,000 reduced from your total capital gains exempt. So that is going to come after you are offsetting your losses. As I mentioned earlier, you have the benefit of offsetting your losses in any manner possible. So you will obviously offset it against the gains that are taxable at a higher rate. Then the 125,000 will be reduced against the gross amount. So that should not matter in terms of which is the more beneficial.
Okay, and last question before we sign off for you. So, will a balanced hybrid fund still meet the criteria of the new definition of a specified mutual fund and be taxed under Section 50AA?
So balanced funds is what is put as a threshold is more than 65% investment in debt. For most of the balanced funds that I see, if they are crossing their threshold, you have hybrid funds and you've got balanced funds. Many of the balanced funds which are there, if they're investing more than 65% in debt, you have 80% debt and 20% equity, then yes, they would fall within that threshold. But some of the balanced funds, if their strategy is to then present it as 50% debt and 50% equity, then those would not be within the threshold. So I would believe that going forward, a lot of the mutual fund schemes that come out would want to target those type of thresholds, which will still qualify for the long-term capital gains and not invest more than 65% in debt securities. But again, that depends on what the product that the mutual fund scheme is coming in. But the threshold is very clear. If that balanced fund scheme has more than 65% in debt, then that would qualify as a specified mutual fund and attract the short-term capital gains asset.
Interesting. Thank you. Thank you so much, Brenden. I think this
Thank you very
session was
much.
extremely valuable and you shed the much needed light on this important topic. Thanks a lot.
Thank you much. Thank you, everyone.
Thank you so much.